All right, so you're ready to dive deep into some seriously fascinating stuff, but don't have a ton of time to, like, sift through all the info yourself, right? That's where we come in.
Yeah, we're going to take those sources you sent. Like, whoa, you sent some great ones, by the way.
Yeah, this is a really good stack.
We got excerpts from Market Wizards by Jack D. Schwager. There's Technical Analysis of the Financial Markets by John J. Murphy.
Oh, classic.
And The Go-Go Years by John Brooks. That one is going to be fun. And then we'll wrap things up with Jared Tendler's The Mental Game of Trading.
Yeah, so the mission here is to extract those golden nuggets from each of these.
Those aha moments.
Exactly. So you can feel like you really got the core of it all without, like, getting lost in a sea of information, you know?
Right.
So today we're going deep on the psychology and techniques of successful and, sometimes not so successful trading.
We're talking about what separates the winners from everyone else.
Yeah, I mean, these sources give us perspectives from, like, legendary traders, right? We got technical analysis principles, some historical context to put things in perspective.
And we're definitely going to cover the mental game, that inner game that honestly makes or breaks so many traders.
I mean, it's huge, right? All right, so let's kick things off with Market Wizards and, like, really get into the human side of trading.
Okay, sounds good.
This one trader talks about his early days and that initial, like, gut-wrenching fear of losing in the soybean market.
I bet we've all felt that one at some point.
Oh, for sure. But then he shares this story almost like a confession about feeling, well, kind of happy seeing Ned Seikoda, the guy's a trading legend, take a hit in a coffee trade.
Oh, wow.
And it wasn't like being mean-spirited. It was more this realization that trading is this, like, super competitive game, right?
It's a zero-sum game in a lot of ways. So.
Totally. Yeah. And that kind of led him to the trading floor of the New York Cotton Exchange.
I mean, talk about a high-pressure environment.
Oh, yeah. So he's talking about these big losses, right?
Yeah.
And there's one, it's a $2.5 million loss just from, get this, not doing anything.
Wow.
Just, like, frozen.
Yes. Analysis paralysis.
Yeah. And it's a big reminder that sticking to your plan, like having the discipline to follow through even when things feel shaky, that could be so crucial.
I think that's one of the hardest things to learn in trading, right?
Totally. Okay, then there's this other story. It's he calls it the going bust trade.
Uh-oh.
And he makes like 6 times his money.
Okay, not busting then.
Right. And here's the thing, he realizes he didn't really understand the risk he was taking, like, at all.
Oh, so it was more luck than anything else?
Yeah. And it was such a wake-up call that he made this rule.
Yeah.
Close everything out, all positions, if you're feeling super emotional.
Basically, when in doubt, get out.
Right. Because sometimes your gut is telling you more than any chart or indicator ever could.
That's interesting. I mean, using your emotions as a risk management tool.
Yeah. So there's this part where the trader compares technical analysis to a thermometer.
Ah, I like that analogy.
Right. He says, fundamental analysis without technicals is like a doctor ignoring a patient's temperature.
It makes sense.
It's about reading the market's mood right now,
Yeah.
not just the underlying story.
Like, is the market hot? Is it cold?
Exactly. It's spotting those little imbalances that could, signal a big shift.
Like a fever could indicate something more serious going on?
Yeah. And then he drops all these trading rules.
Hit me with them.
Never average losers. It's like rule number 1.
Golden rule.
Right? Then adjusting how much you're trading based on how well you're doing.
So more size when you're winning, smaller when you're not.
Totally. Riding those winners, cutting losses short.
Classic.
And stay away from situations you can't control, like trading right before a big news announcement.
Right. Pick your battles.
And this one, this one, if a losing trade is making you, like, seriously uncomfortable, just get out.
Don't torture yourself.
Exactly. It's not worth the mental anguish.
I like that.
Another thing, your initial entry point, it doesn't matter as much as what the market's telling you right now,
So focus on the present moment, not what you paid.
Yeah. And always, always play defense first.
Assume every trade could be wrong.
Yeah. It's a huge mindset shift.
It really is.
So he tells this story about a pork belly trade. He makes like double his money.
Nice.
Right? But it made him, well, a little cocky.
Overconfident.
Totally. And then, bam, he gets humbled big time in the corn market.
The market has a way of doing that.
Oh, yeah. He also talks about the 1987 crash. And he was actually cautious beforehand.
Smart.
Right. And he thought all these buybacks and, like, rising debt were red flags, signs of things getting bubbly.
That's interesting.
But what really surprised him was that the things that actually set off the crash, like some Fed tightening, disagreements about currencies, those didn't seem that big. you know?
Right.
And it made him realize that, like, under the surface, things were way more fragile than people thought.
It's those hidden vulnerabilities?
Yeah. Okay, so then there's this whole can slim investment strategy. Have you heard of this?
Yeah, it's about finding those explosive growth stocks.
Right. It's current quarterly earnings, annual earnings growth, new products or management, supply and demand, leader in its sector, institutional sponsorship, and market direction.
It's a whole system.
Yeah, and here's the crazy part. It says to buy stocks at new highs.
Yeah, buy high, sell higher.
I know, right?
Right.
It's counterintuitive, but like the idea is that those stocks making new highs, they have this momentum.
Right, they're the leaders.
Exactly.
Yeah.
So then we get into how this trader switched from being a fundamental analyst to a technical analyst.
Interesting.
Yeah. He'd been doing fundamentals for 9 years, and then bam, he finds all this success as a technician.
So sometimes you got to try different approaches.
Yeah. And he talks about the leap of faith he took to become a market maker, like going out on his own.
That's a bold move.
Oh, for sure. Then there's this story, hold on to your hat. He loses $600,000 on election day in 1982.
Oof.
He was short and kept adding to the position as the market went, like, totally against him.
Ouch.
Yeah, big ouch. The lesson: reduce your size after a big hit. Focus on getting back to even, and don't try to chase those losses immediately.
That's solid advice.
Right. So then he drops some more wisdom. Always ask yourself, like, do I really want this trade? Take a break after a winning streak, to avoid burnout.
Important.
Bottom fishing is dangerous. Don't try to catch falling knives, even if you think you have a good entry point.
Right. The market doesn't always play fair.
And know your uncle point, your max loss before you tap out.
Risk management 101.
Also, watch out for conflicting signals from T-bonds and T-bills.
Intermarket analysis. Gotta love it.
And last but not least, work, and more work.
Can't argue with that.
It's all about that hustle. Then he talks about, like, waiting for those high probability setups, like shooting fish in a barrel.
Right. Be patient and selective.
And he used Commodity Research Bureau charts to, like, find those moments of hysteria in the market.
Interesting. Looking for emotional extremes.
Yeah. Because those are often signs of a potential reversal,
Like a rubber band stretched too far.
Exactly. And he learned about this fading hysteria the hard way.
Oh.
He had this early win in a bear market using put options.
Okay.
But then he shorted Memorex, and he was right, fundamentally. But he got wiped out.
Right. Being right doesn't always mean you win.
The market doesn't care about your analysis if your risk management is bad.
Hard lesson.
It is.
Yeah.
He also talks about why he even became a full-time trader after being a successful broker.
I'm curious.
So he was influenced by his clients, and then he had some early losses trading, which actually made him reduce his position sizes and become more reactive to the market.
Huh. It's not the usual path.
I know, right? And get this, he says that, like, on the trading floor, maybe only 5 out of 100 guys actually make $1 million in 5 years.
Wow, that's a low success rate.
And at least half of them lose everything.
So it's tough out there.
Super tough. And he says his success came from being a great listener.
Interesting. Not what you'd expect.
I know, right? It's about taking in information, not just shouting your
It
opinion.
makes you think.
Okay, last bit from this guy. His own path was, like, super unique.
Tell me about it.
So he started as a caddy for grain traders, then he became a phone broker, and then he jumped into the Chicago Board Options Exchange.
Options trading, that's a whole other world.
Yeah, and the crazy part is a former caddying buddy actually backed him financially.
That's a good friend.
It is. Okay, so we got to move on to Technical Analysis of the Financial Markets by John J. Murphy.
All right, let's get technical.
So he starts by talking about, like, different types of technical analysts, right?
Okay.
There are the traditional chartists who are all about, like, visual patterns and experience. And then there are the statistical technicians who use math and, like, data crunching.
Art versus science.
Yeah, and it's probably a blend of both that works best.
Likely.
So he applies Dow theory to futures trading. And he says, futures traders need to pay more attention to the minor trends, not just the major ones.
Right, because they're trading on shorter time frames.
Exactly. Okay, trend lines, super important concept.
Fundamentals of charting.
You need at least 2 reaction lows for an uptrend line, 2 highs for a downtrend.
Got it.
And these lines, they act as support and resistance.
Like boundaries.
Yeah. And if you break below an uptrend or above a downtrend, that's a warning sign.
Potential change in direction.
And then there are channels, which are like parallel lines above and below the trend line.
Okay, so like a range for the trend.
Exactly. And if prices stay within the channel, the trend's strong.
But if they break out, it could mean the trend is accelerating.
Yeah. Or if they fail to reach the channel lines, it could be weakening.
Makes sense.
Now, let's talk chart patterns.
Love those.
So, symmetrical triangles, they're usually continuation patterns, meaning the trend's probably going to keep going in the same direction.
Okay.
You need at least 4 reversal points to, like, confirm it.
Got it.
Then you got head and shoulders patterns, which are usually reversal patterns, but they can be...
Right. Sometimes they fake you out.
Yeah. And volume is super important for confirming these patterns, you know.
Absolutely.
Like in an uptrend, you want to see volume increasing as prices go up.
Shows conviction.
And with a head and shoulders top, volume often gets lighter during the formation and then heavier on the breakdown.
Confirmation of the move.
Yeah. And with those continuation patterns, declining volume during the pattern and then like a surge on the breakout, that's a good sign.
It's all about that volume.
Okay, open interest. This is especially important in futures.
Right.
High open interest within a trading range means a lot of people are in the trade. And if it breaks out, you can get some huge moves as those on the wrong side. Got to get out fast.
It's like a pressure cooker.
Yeah. He also talks about looking at longer-term charts, like weekly and monthly.
Right, it's a big picture.
They help you see the overall trend without getting distracted by the day-to-day noise.
Filter out the noise.
Moving averages, everyone's favorite, right?
Classic.
There are simple moving averages, exponential moving averages.
No clear winner.
Right, and you got all these combinations, the 4 and 9, the 50-day and 200-day.
So many options.
It's a whole world. They can be used for support, resistance, creating breakout systems, you name it.
Versatile tools.
Momentum indicators, these measure how fast prices are changing.
Right, speed and acceleration.
Shorter-term ones are more sensitive, longer-term ones are smoother.
Different strokes for different folks.
And when momentum is above 0 and rising, it usually means the uptrend's getting stronger.
Got it.
Divergences between price and momentum can be warning signs, but you got to be careful with those.
Use them in context.
Okay, oscillators, these are best for choppy sideways markets.
When things are ranging.
But sometimes they give you overbought or oversold readings right when a breakout happens.
Tricky.
It's like they're contradicting the price action.
Yeah, it's all about reading the market.
Then there are point and figure charts, which are totally different.
How so?
They only look at price, no time element, and they use X's for up moves, O's for down moves. And they might give you more precise signals than bar charts, especially with the 3-box reversal method.
Another tool for the toolbox.
Okay, then we got Elliott wave theory and Fibonacci numbers.
Oh boy.
Yeah, it gets a little complex here, but basically, Elliott wave says markets move in these 5-wave patterns with the trend and 3-wave patterns against it.
Okay.
And Fibonacci sequences and that golden ratio, like 0.618, are used to figure out the relationships between those waves.
It's all about those patterns.
And there are Fibonacci retracement levels, 61.8%, 38.2%, 50%, which can act as support, resistance, or price targets.
It's a whole system.
Then there are cyclic principles, which say price movements are like the sum of all these different cycles happening at the same time.
Market rhythms.
Yeah, and if you can figure out those cycles, you could, in theory, predict future prices.
That's the holy grail.
Right. He also talks about parabolics and the directional movement index, or DMI.
Okay.
Parabolic SAR can give you trading signals, and it works even better with the DMI.
A dynamic duo.
And the ADX, which is part of the DMI, tells you if the market's trending or ranging, so you know which tools to use.
Right tool for the right job.
Okay, last bit on technicals money management.
Crucial.
Don't put all your eggs in one basket. Limit your exposure and leverage stuff like futures, and know your max risk for each trade.
Sound advice.
And scaling in and out of positions can be a good strategy too.
For sure.
Okay, he talks about breaking trend lines as entry and exit signals, and even buying against a broken uptrend line or selling against a broken downtrend line, looking for a reversal.
Contrarian plays.
But you always want to confirm with other signals.
Right. Don't just rely on one thing.
Intermarket analysis. This is about how different markets are connected, like currencies, commodities, bonds, stocks.
It's all connected.
A strong dollar often hurts commodities. Gold and the dollar often move in opposite directions.
Interesting relationships.
And understanding these relationships can help you analyze different stock sectors.
Gives you broader perspective.
Yeah. Then he talks about the demand index, Keltner channels, candlestick patterns.
Candlesticks, gotta love those.
And all sorts of oscillators.
So many tools.
Right. It's overwhelming, but it's cool to see all the options.
Okay, so now we're on to The Go-Go Years by John
Now,
Brooks.
let's get some historical context.
Like it's back in time.
So this book is all about the 1960s, this era of like crazy speculation and huge growth.
The Go-Go Years, indeed.
And there's this guy, Eddie Gilbert, who made a ton of money through some, shall we say, creative stock manipulation.
It sounds shady.
Oh, yeah. And he lived this super lavish lifestyle. But the book kind of hints that it all came crashing down eventually.
What goes up must come down.
Right. Then we meet some interesting characters like Michelle and Rickless and Charles Bluedorn. They built these huge business empires. And it was this time of like bold entrepreneurship,
The era of conglomerates.
Yeah. But the book also talks about this massive problem on Wall Street in 1968, the back office issue. They were totally understaffed using outdated tech, and they just couldn't handle the crazy amount of trading.
Sounds like a recipe for disaster.
It was. It created all this instability in the market.
When the infrastructure can't keep up.
Yeah. Then there's this weird story about Lisaco and Chemical Bank.
What happened?
So Lisaco's stock price tanked right when they were about to do this takeover. And the book suggests it might have been market manipulation, like a bear raid.
Wow, so there were forces at play beyond just the news.
Yeah, it's a reminder that things aren't always what they seem.
Okay, so last but not least, let's talk about The Mental Game of Trading by Jared Tendler.
All right, let's get into our heads.
Time for some introspection.
So he starts by listing all these common trading mistakes we make because of our emotions, right? Forcing trades, hesitating on entries, getting out of winners too early, chasing prices, moving stop losses too soon, changing profit targets all the time, talking yourself out of good trades.
We've all been there.
And the worst part is you're doing it, but you can't seem to stop.
It's a vicious cycle.
It is. But Tendler says, instead of fighting our emotions, we should see them as signals.
Interesting.
Right? They're telling us something about ourselves and about the market.
So emotions as data.
Exactly. Then he has this A game, B game, C game thing.
I like that.
A game is your peak performance. C game is when you're emotional and making all the mistakes.
So the goal is to avoid the C game as much as possible.
Yeah. It's not about being perfect. It's about raising your average.
Yeah. Makes sense.
And he says trying to just like control your emotions doesn't really work in the long run.
Band-aid solution.
You got to address the root cause, the flaws in your thinking that are causing those emotions.
Okay, how do we do that?
He has a 3-step system. Identify the emotion, understand why you're feeling it, and then correct the underlying issue.
Sounds logical.
It is. It's a more like permanent solution.
Right, fix the root, not the symptom.
Then he goes into detail about specific emotions.
Let's hear it.
Greed, bragging about wins, ignoring your plan, that kind of stuff.
Classic.
Fear comes from a weak strategy or bad analysis, makes you overthink and hesitate.
Paralysis by analysis.
Tilt or anger makes you blind to risk and think you're always right.
Dangerous.
Hatred of variance, hating that the market's random, basically.
Frustration with the unknown.
Entitlement, feeling like you deserve to win just because you put in the effort.
Oh yeah, that one's a trap.
Overconfidence, thinking you're better than you are, cutting corners.
Can lead to big mistakes.
Lack of confidence, which can be fluid and comes from all these negative beliefs.
It's a mental game.
Poor discipline, breaking your rules, not sticking to your routine.
That's a killer.
And finally, laziness and procrastination, not doing the work you need to do.
We all struggle with that sometimes.
So Tendler says the goal is to fix these flaws so you can think clearly and make better decisions.
Make space for better trading.
Yeah, and he talks about injecting logic to combat those bad thought patterns.
Retrain your brain.
Exactly. All right, last thing. When Genius Failed, the story of long-term capital management.
Oh yeah, that one's a classic.
So these guys were like super smart, but they started having these internal fights as they lost money.
Ego clashes.
Oh yeah. Blame, resentment, all that.
Not a good mix.
And one of the partners felt like he was being ignored when he warned about the risk they were taking.
That's a red flag.
And the crazy part is, the banks complained about LTCM secrecy, which is exactly what the partners were complaining about with each other.
Lack of transparency on all levels.
Yeah, it shows how a lack of trust can destroy even the smartest teams.
It's a human story as much as a financial one.
So, to wrap things up, it's clear that trading and investing isn't just about strategy and tools, right?
Right. It's about so much more.
It's about understanding your own psychology, managing your emotions, recognizing that markets can get crazy, and respecting risk.
It's a holistic game.
Totally. So think about your own decision-making. What triggers your best and worst trades, and how you can use these insights to, level up your game.
And never stop learning, both about the markets and about yourself.
That's the key. Thanks for joining us on this deep dive.
It's been a pleasure.
Until next time, keep learning, keep growing, and keep diving deep.
And don't forget to manage your risk.
Always good advice.